What's going on, guys? How is it going? That was the first video that I am trying on having the little intro in there. You guys like that? You guys like that? We have a god tier GME update. We not only have an incredible mega thread on Twitter to talk about with the rock god, but we also need to talk about why the gamma squeeze possibility is now much higher as of today, Friday, March 5th. How is your Friday doing? Happy Friday, guys. Thank God it's Friday because we have a lot to cover. So right now we have let's put on the reading mode. We got GameStop pre-market, and already we have this god tier DD got banned on Wall Street bets for posting, and now we are going to be able to read not only this but also some extra DD about the possibility of a gamma squeeze just going through the roof. Hopefully this guy's we find a little bit of extra help in here by smashing that like button so other apes can find this, and by smashing that subscribe and the notification button. We're not quite at 35,000 yet as of recording, so we're looking to buy $1,000 of GME for yours truly when we hit that $35,000 mark. So let's talk about GME. Too long didn't read. The number of possible contracts in the money could be double last week's expiry. Over 4 million shares could be called on for these exercise options, only adding to the ever-increasing snowball. Here's what they did. They pulled the option chain data into Excel, ran some numbers on open interest, and found some crazy info. What is a gamma squeeze? Well, let's explain it simply. For those who don't know what a gamma squeeze is but have heard it thrown around, let me give you a brief explain like I'm 5. Gamma squeezes revolve around options. They won't go into too much detail, but basically you purchase contract which gives you the option to buy the stock at a set price and a future date regardless of what the stock's current price is. Contracts are typically in lots of 100 shares per. Option contracts are not usually sold by individuals, but rather market makers, biggest of whom being auction houses out of Chicago. Hey, Chicago, represent, all right? They have a complex price model which values contracts at set prices for set contracts, based on probability of them being in the money. Of course, the higher the stock price of the contract, the lower the cost because the odds of that happening is low. They always have to be higher than the current price of the stock, so it's kind of like betting. It's actually like a real horse race. It's a real gamble to see whether or not a stock can be in the money in the time period allotted. So these market makers thought GME was garbage, sold way more contracts than they could feasibly handle, because what are the odds of GME at $15 going to $150? Oh boy, here it comes. Market makers selling these contracts need to buy shares to hedge, which of course will cause the price to rise more and more. That's the best explain like I'm 5 I've seen so far. Now that GME is at 130, it's hovering right around that price even before the market opens. Today was a great day. GME closed at $8 or 6.5% up. Maybe not the crazy gain some hope for, but on a down market day, GME is making us proud. Now a rise in only $8 may not seem like it has much impact on gamma squeeze potential, but just you wait. All right, options expiring today. GME at 100. This is the level going into Friday. We should expect 22,000 contracts in open interest, right? So this is 100 times. The contract amount is the number of shares going in the money. So that is 2 million or 5% of total float. But we're not done. At 130, there are 35,000 contracts. That's another 3.5 million. Oh boy. That's 8% of total float. And now we're getting nutty. Closing Friday above this level brings about $150. That is another 46,000 contracts. Oh, okay, sorry. This is a total 46,000 contracts. That is a whopping 4.5 million shares, or 10%, more than double $100. So, mumble jumble aside, what does this mean? Well, not every contract will be exercised even in the money. These market makers also have likely been finding shares to hedge for some time now. So that means they've already bought a share. That's what hedging a bet is, right? You're not really all the way in one of these bets, and you're not all the way out one of another bets. So it's entirely But it's entirely impossible to ignore that if every contract were to be exercised, 10% of all of the shares in circulation would be needed. And if anyone knows anything about supply and demand, it means more contracts will come in the money next week. Because if we keep putting the buy pressure on the stock, the price goes up and more stocks become in the money. And as the market is about to open, we could see the floodgates go pretty crazy. So With the steady price rise we've been seeing, it could be these market makers are slowly buying up shares to hedge. Could is operative, and this is entirely speculation. What we do know is that massive amounts of money have been changing hands over this past week in GME. There's been crazy volume at time, particularly today, the day before contract expiry. Anyhow, I'll put away my tinfoil hat. What we could be witnessing is the beginning of the beginning, the first dominoes. Guys, you guys are making me want to buy that $1,000 of GME earlier than getting me up to 35,000 subscribers. Does this information guarantee the stock takes off to the moon and beyond? No, not really, but it does increase the odds of it happening. We probably cannot even fathom how these market behemoths are willing to protect themselves, but we all saw what happened to Robinhood. And what's crazy is the possibility that's the tip of the iceberg for actions they took. It's just the action that we were able to see. Summary: since last Friday, the number of contracts possibly in the money has doubled. Repeat, doubled. If tomorrow closes above $150 and every contract is exercised, 10% of total float will be called on. Even if nothing happens tomorrow and we close $130, there is still 50% more contracts in the money than last week. All this continues to build that snowball that's already to get mighty big. Mic drop, not financial advice. So, with that delicious little candy in our mouths, we have 20 minutes until market open, and we want to be able to read this God thread by, appropriately, a rock god. People talked about GME a whole bunch in January, but I don't think you realize what is happening in the market and how this one stock could result in the greatest transfer of wealth in human history. So I give you this thread. There have been certain pieces of history that's ever been created, and now it is about to be one of the greatest wealth transfers. Do you want to be on the right side of history? Let's see. It all begins with the fact retail is dying. People buy things online. Games now have downloadable content, and you don't need to buy discs or cartridges anymore. So people don't visit the store as often. The storefronts are tired, and 20 years ago, profits were spent on buying back $30 of its stick to keep the price from dropping so much they get delisted. They went from 100 million shares to 70 million shares, 20 of which are owned by insiders and can't be freely traded. Then about 35 million of the remaining 50 million shares are owned by big investment and index funds, while the remaining 15 million shares are owned by retail investors. Average folk like you and me, we're too poor to be invited by a hedge fund and put these shares in our meager portfolios or our 401ks. It is important you remember that there are only 50 million shares that can trade. Now, to stay afloat, GameStop issued some bonds, and the first big set of bonds, imagine as if they took out a multi-million mortgage on their business, scheduled to mature to do so in the next week or so. Sometime last year, some poopy ass hedge fund bros saw GME struggling, then got hit by the pandemic and decided it was time to short the shot out of the stock and become cajillionaires. They borrowed the stock, millions of shares of it from the index funds, and then sold it, expecting the price to crater, and then scooping up the cheap shares and giving them back to the people they borrowed from. If GME were to bankrupt, then wouldn't need to give back the shares or even declare capital gains. So this is the message that we've been telling on this show for a long time. This is exactly what's been going on with the short squeeze situation. Billions in profit, tax free. So fully expecting GameStop to default on their bonds, they shorted and they borrowed more, and they shorted and they borrowed some more and they shorted. And who was buying the shares? Regular dorks like us. Retail investors were buying and hoarding the stock. By January, the shares on GameStop had been shorted something like 140%. But how does that happen? Well, once the stock is borrowed and shorted, someone like me buys the share, and I would be counted as an owner, and the fund from which the shares were borrowed gets counted as an owner too. So this is the analogy that one of my very first videos on YouTube was talking about, how Meatball and several other dogs can own one dog treat. Essentially, if I promise Meatball a treat and then give it to another dog, then borrow it from that dog and promise it to a third dog, now that one treat belongs to 3 different dogs. I have overshorted that stock. So once the stock gets borrowed and is shorted, someone like me buys the shares, they would count as the owner, and the fund from which the shares were borrowed gets counted as an owner too. Then the stock sits in my brokerage account, and my broker lends the stock to a hedge fund and shorts it again. So someone else bought the shares and they're counted as an owner, I'm counted as an owner, and the index fund is counted as an owner. Before long, this has gotten out of control, and the index funds wanted their shares, excuse me, excuse me, Rock, back, and the price of the stock had risen above what the hedge funds had shorted it for, and the retail owners refused to sell. This is called a short squeeze, and the result was a stock going from $2.57 to $480 in a year. It wasn't that GME generated business that warranted such a high price, but the fact that hedge funds got out of their skis and their greed hoisted their petard. 11 hedge funds went bankrupt, and the biggest, Melvin Capital, was down 53%. The stock fell and bottomed out at $40 a share, and it wasn't done. More hedge funds' loans were due, so they had to buy back the stock and give it back to their lenders, and the price spiked again last week to around $200. This caused a new problem: options market. And now we're talking about an entirely new, different kind of squeeze. Options markets are weird to the average person because people have stock in 100 share blocks and sell options to buy, known as call options, where you purchase the right to buy the stock at the set price of the market for that stock going up. For example, an options writer makes an out-of-the-money option for GME back in Christmas at $80 a share that has a date of February 26th. That means if someone buys the option at $1 a share for $1 a share for 100 shares, and by February 26th the stock is more than $80, they can exercise the option and get all $100 shares for below market value and $80 a share. So the options writer, all 100 shares, this dollar sign is not supposed to be there. The options writer must sell them those shares or else. Well, let's find out. Well, when a stock is trading at $20 and the options writer sells an $80 option, they don't actually own the shares, because who expects a poopy stock like GME to shoot up 300%? This is called a naked option, and the options trader now has to find the shares to fulfill the order. The problem is that he only got paid $81 per share, and last Friday's shares were $100 each. That one extra dollar is the premium to buy the option to get that share. So the options guys are hemorrhaging money because the stock went from $40 to $100 in 3 days, and all the contracts due on February 26th from $100 on down were now in the money. On top of this, a whole bunch of short sellers were doing naked shorts, meaning they were selling stock they didn't have on the promise that in 2 days they would find the shares and deliver them, betting that the price would drop and they would find cheap shares to fulfill that order. As it stands, between the shorts, and naked call options, and the rich people who have to find something in the neighborhood of 200 million to 500 million shares to fill their orders, there are only 50 million physical shares in existence, all now in the hands of retail investors who are refusing to sell, and millions more naked shares from call options will be in the money come tomorrow afternoon if the price remains above $100. Every evening after the market closes, the brokerages do some accounting with the clearinghouses. They even blank their books to see that X number of shares moved here and Y dollars moved there, because sometimes they find that 3 million shares were supposed to move from a hedge fund account with brokerage A to accounts with brokerage B, but the hedge fund account with brokerage A only has 2 million physical shares to give. This is known as a failure to deliver. So brokerage A looks at their other accounts and sees that there are another million shares owned by their customers, and loans these 1 million shares to the hedge fund to give to brokerage B. This is if you have Robinhood or even Webull and are not opting out of having your shares be lended to someone else. This essentially bails out people who don't have the shares they need to cover. And A's hedge fund account has 21 days to find 1 million more shares or else. This or else is big because 21 days pass and the hedge fund hasn't found these shares. Brokerage A is required to liquidate the hedge fund's assets and buy the stock at any price to fulfill their obligation. If the retail investors demand $1 million a share, then brokerage A has to pay $1 million a share and liquidate the $1 million at the hedge fund's assets to pay for it. The same goes for the options writers. If they go 21 days from when they sold the shares and don't deliver, they now have to liquidate assets and pay any price for these shares, even if it's at the moon. And they now have to do this hundreds of millions of times because remember, there are 200 to 500 million naked and synthetic shares out there, but only 50 million physical shares. They don't know they don't know how they will get physical share or the synthetic one when someone offers to sell, and they have to keep buying until all orders are filled. Hedge funds and entire options markets will go bankrupt. If there are 500 million shares bought at $100,000 each, then these groups have to come up with $50 trillion. No one has that kind of money, so they will be liquidated out of existence. And the instances, companies and the clearinghouses themselves will have to start buying shares with their $63 trillion in insurance fund, which is basically just the Federal Reserve printing money. The entire global economy is only $87 trillion, and for a brief few days, GME has the power to not only be a $7 trillion company, making Ryan Cohen possibly the first trillionaire, but to essentially see almost all the cash on earth go to fulfilling a whole bunch of shisa bets a bunch of douche bros made filter into the hands of poor schlubs from Reddit who called their bluff. Something like 63 multi-billion hedge funds could face annihilation. It takes $1 million in liquidity and a yearly salary of $200,000 or more to invest in most hedge funds. Much of the 1% is about to lose all their wealth to a bunch of potty-mouthed degenerates from internet message boards, and the fear is palpable. Thus, potentially the greatest transfer of wealth in human history is but days or weeks away. And if that made you have your hair stand on edge, well, it's not just you. Markets are about to open, and we are about to see what is going to happen. I hope you enjoyed that recap explained in plain English from 30 different tweets. I also hope you guys liked the DD that happened in the very beginning. Thank you guys for showing up all the way to the end of this video. It means that you guys love this channel and want to drop your meatball subs, and also hit that bell button as well, so you don't miss out on another live stream where we talk about this early and give Meatball a little boop on the nose for me by pressing that like button. These people are all of my supporters. We have Meatball the Professor tier over here, and the highly coveted Meatball the Space Legend tier over here. Thank you guys for every one of you who supports me, and for now, but not for forever, I'll see you guys in a future video.